All right, welcome to the deep dive. We take, a whole stack of really interesting sources and zero in on what actually matters. And then we try to give you those insights so you can be well informed without feeling completely buried. Today, we're going to be talking about understanding financial reports.
Oh, yeah.
These are documents that might seem super dense and kind of scary at first glance,
Yeah.
but actually they hold like the key to knowing what's really going on with any business.
Yeah, that's right. It doesn't matter whether you're, heading into a meeting or maybe trying to get a handle on a new industry, or just even if you're just curious about how companies work, like being able to actually read a financial report, it's like having a secret decoder ring.
Yeah.
You can see past all the fluff and like understand the actual financial health.
Yeah, I love that. A secret decoder ring. That's a great analogy. So, our goal today is really straightforward. We want to equip you with the essential tools for reading a financial report. And to do that, we're going to be drawing on the book How to Read a Financial Report by John Tracy and Tage Tracy.
Great book.
Yeah, and hopefully we can kind of cut through all the complexity and really highlight what's most important. Consider this your like express lane to financial literacy.
Totally.
And at the very core of every single financial report, there are three main statements, and we'll be focusing on those today.
Yeah.
Those are the income statement, the balance sheet, and the statement of cash flows.
Right.
These are like the foundational documents.
Yeah.
They give you that comprehensive picture of a company's financial activities and its position.
Absolutely.
Okay, so the authors start off with something that, you might think is pretty basic, but it's absolutely fundamental, and that is cash flows.
Yeah,
They even call it the pulse of a business.
it really is.
So why is it so critical for us to understand cash flow?
Well, because, it's the flow of actual cash, like
Yeah.
money actually coming in and going out.
Yeah.
That's what keeps a business alive.
Yeah.
I mean, you can have a company that looks really profitable on paper, but if the cash isn't coming in to actually cover the expenses,
Right.
it can find itself in trouble really, really fast. I mean, think about your own personal finances. You might have a bunch of assets, but if you don't have the cash on hand to pay your bills,
Yeah.
you've got a problem.
Exactly. Yeah. You can be making sales all day long, but if the money isn't actually hitting your bank account, you can't pay your suppliers. You can't pay your employees.
Right.
But the authors also point out that just looking at a basic summary of cash flows, that doesn't tell you the whole story.
Well,
It doesn't give you the complete picture of a company's financial health or even necessarily its profitability.
that's true. That's a super important point. A summary of cash flows basically just shows you the net change in the cash over a period. It's not going to tell you how much cash the company actually has at the end of that period.
Right.
And it doesn't tell you anything about what assets the company owns or what it owes to other people.
Okay.
So it's really tracking the movement, the flow of cash, but it's only one piece of the puzzle.
Okay, so that brings us to another kind of interesting point, which is that the cash a company collects isn't always the same as the sales revenue they report.
Right.
And the cash that it pays out isn't always the same as its expenses. So why is there that difference?
It's all about the timing. It's about when a transaction is recorded versus when the cash actually moves. So for example, like a company could make a big sale to a customer in December, right? And they'll record that as revenue for the year. But let's say that customer doesn't pay the bill until January of the next year.
Oh.
So the revenue is in one period, but the cash is in another. Or, on the flip side, a company might pay for a bunch of raw materials in one period, but not actually use those materials to produce goods and sell them until a later period.
All right.
So the timing can be different. And it's really important to only match the cost of the goods that were actually sold in a specific period against the revenue from those sales.
Okay.
That's how you accurately calculate profit. It's about aligning, the economic activity with the correct time frame.
I see. So it's not just when the money goes in and out, it's about when the actual economic event happens.
Yeah, exactly. When the economic value is created or consumed.
Okay, I got it. And the authors stress that managers, the people running these businesses, they really need to have a deep understanding of a company's assets, what it owns and its liabilities, what it owes to others,
Right.
to make sure that, things are on solid footing.
Yeah, for sure. Managers have a huge responsibility to make sure that the company is solvent, which means that it can meet its long-term financial obligations and that it's liquid, meaning it has enough cash available to handle the short-term stuff, like paying salaries.
Yeah.
And they also have to keep an eye on the levels of assets and liabilities relative to the sales. You got to make sure everything is in a healthy balance.
It seems like there could be a lot of, room for interpretation
Yeah.
in how companies report these things. But the authors mention something called GAAP, Generally Accepted Accounting Principles.
Right.
So what role does that play?
Well, the accounting profession, they're the ones who establish and enforce GAAP. It's basically a set of rules. Think of it as like a rule book
Yeah.
that all publicly traded companies in the U.S., they need to follow those rules when they're reporting their profit, their financial condition, and their cash flow.
Okay.
And the main goal is to create transparency and comparability. So companies can't just go and, invent their own accounting methods to try to make themselves look better than they really are.
Right. Yeah.
It provides a level playing field,
Mhm.
a baseline of consistency.
Okay, so we've talked about cash flow, that immediate pulse of the business.
Right.
Now let's get into the two fundamental financial statements that give us like a much wider view of a company, and that's the income statement and the balance sheet.
Yeah.
So let's start with the income statement. What is the main information we can get from that?
Okay, so the income statement, it basically shows a company's financial performance
Okay.
over a specific period of time, like a quarter or a year.
Okay.
And it follows a step-by-step process. It
Yeah.
starts with the total revenues the company brought in,
Okay.
and then it subtracts all the different costs and expenses.
Yeah.
And at the very bottom, you get to the bottom line.
Yeah.
And that's the net income or the profit.
Okay. Okay. And they talk about how income statements can either be multiple step or single step.
Right.
What's the main difference from our perspective as someone reading these reports?
So the multiple step format, which is what you'll usually see, it actually breaks down the expenses into different categories. So you get these intermediate profit figures along the way.
I see.
So typically you'll see something called the gross margin first,
Okay.
which is the revenue minus the direct costs of producing the goods or services they sold.
Okay.
Then you'll see operating earnings after they've subtracted other operating expenses,
Okay.
like sales and administrative costs and depreciation. Then you'll get earnings before interest and taxes,
Yep.
then earnings before taxes, and then finally the net income. So you're basically stepping down.
Yeah. Yeah.
The single step format, it's much simpler. All the revenues are listed together and all the expenses are together.
Yeah.
And then they just subtract those to get to the net income. So it's much simpler.
Okay.
But the multiple step format, it really gives you more insights into how the profit was generated.
I see. So the multiple step lets you see like the different stages.
Exactly.
Okay. And then, you always hear people talking about gross profit.
Yeah.
Where does that fit in?
Yeah. So gross profit is basically just another name for that initial profit figure, the gross margin.
Okay.
It's what you have left from your revenue after you've paid for the direct costs of what you actually sold. And, it's interesting. It's one of the few places on the income statement where you'll see the word profit.
Oh, really?
Yeah, it's used explicitly.
Interesting.
It really tells you how efficient the company is at producing its core products or services.
Okay. Now, publicly traded companies, there's one number that they absolutely have to report, and that is earnings per share, or EPS.
Right.
Why is that so important?
Because it's a fundamental measure of the company's profitability on a per share basis.
Yeah.
And this matters a lot to investors.
Yeah.
Because it's a key input when it comes to actually valuing a company's stock.
Okay.
So analysts and investors, they pay super close attention to that number.
Yeah.
Now, private companies, they don't have to report it,
Okay.
but, it can still be a helpful metric for the owners to keep track of.
Okay, so when we're looking at an income statement, what are some of the common, categories of expenses that we might see?
So, as we said before, you'll usually see the cost of goods sold. That's the direct cost of making the stuff that they sell.
Right.
Then you've got selling, general, and administrative expenses, and those cover, a big range of operational costs that aren't directly tied to production.
Okay.
So things like marketing, salaries for administrative staff, rent, that kind of thing. Then you'll see depreciation expense, which we can talk about more later. But basically that reflects the wear and tear on the company's long-term assets.
Okay.
And then you've also got interest expense, if the company has any debt. And then finally, income tax expense.
All right, so that's the income statement, and it gives us a summary of a company's performance over a certain period.
Right.
Now let's move to the balance sheet.
Okay.
So what does the balance sheet tell us that the income statement doesn't?
So the balance sheet is different because it's a snapshot. It's like a picture of the company's financial position at a specific point in time.
Okay.
So it can be the end of a quarter or the end of a year.
Okay.
And it shows what the company owns, which are its assets, what it owes to other people, which are its liabilities.
Yeah.
and then the difference between those two,
Okay.
which is the owner's equity or stockholder's equity.
Okay.
And the really fundamental equation for the balance sheet is assets equals liabilities plus stockholders' equity.
Okay.
So it's like a snapshot of the company's resources and its obligations at that specific moment.
Okay. And how are those different components, like, usually listed on a balance sheet? Is there, like, a standard order?
Yeah, usually there is.
Huh.
So assets are listed in order of liquidity, which is basically how easily and quickly they can be converted into cash.
Okay.
So you'll typically see cash at the very top, followed by things like accounts receivable, which is the money that customers owe to the company,
Yeah.
and inventory. And then liabilities, they're listed in order of maturity, which is how soon they need to be paid.
Mm.
So the short-term stuff comes before the long-term debts.
Okay, that makes sense. Now, the authors also use this term accounts. What does that mean when we're talking about a balance sheet?
Accounts are just the individual line items that you'll see on the balance sheet.
Okay.
So each specific asset, each liability, and each part of the stockholder's equity, it all has its own account.
Okay.
It has a name and it has a balance. So cash, accounts receivable, inventory, accounts payable, those are all examples of accounts.
Okay, so it's basically like every single line on the balance sheet.
Yeah, exactly. It's like a little container.
Okay, I got it. And then the assets are also broken down into these different categories, right? Like
Right.
current assets and long-term operating assets. What's the difference?
So current assets are the things that a company expects to convert to cash or use up within a year.
Yep.
So it could be things like cash itself, obviously, accounts receivable, inventory, and prepaid expenses. Prepaid expenses are costs that a company pays in advance
Okay.
for future benefits.
Mm.
Like, let's say you pay your insurance premium for the next 6 months. That's a prepaid expense.
Oh, okay, I see. And long-term assets.
Long-term operating assets, those are the ones that are used in the company's operations for more than a year, and they aren't intended for resale.
Oh,
These can be tangible things like buildings, machinery,
okay.
or intangible things like patents and trademarks.
Okay.
So those are the long-term operating assets.
Okay. And then liabilities, they are categorized in a similar way,
Yeah.
right? Exactly the same way.
Current versus long-term.
Current liabilities and long-term liabilities. So the
Mhm.
current liabilities are those that are due within a year.
Okay.
And these often have a close relationship with the current assets.
Oh, okay.
For example, accounts payable, money that the company owes to its suppliers.
That will likely be paid using cash that they collect from their accounts receivable.
Makes sense.
And then short-term loans also fall in that category. And then long-term liabilities are debts that aren't due in the next year.
Okay.
So like long-term bank loans or bonds payable, those are examples of long-term liabilities.
Okay. And then finally, we've got the stockholders' equity. What is that all about?
So stockholders' equity, it's the owner's stake in the company.
Okay.
It's what's left over in the assets after you subtract all the liabilities.
Okay.
And for a corporation, this includes the value of the stock that's been issued, which is called the capital stock, and retained earnings.
Okay.
And retained earnings, it's basically the accumulated net income that the company's made over its lifetime, and that it hasn't paid out to shareholders as dividends.
Okay.
So it's kind of like the net worth of the company from the owner's perspective.
Okay, so we've got the income statement that shows us how a company performed over a period of time.
Right.
We've got the balance sheet, which is a snapshot in time.
Yep.
Now, we've got this third really important statement, the statement of cash flows. How does that tie together the other two?
So the statement of cash flows, it acts like a bridge between the income statement and the balance sheet
Okay.
by specifically tracking the movement of the cash.
Okay.
So where it came from and where it went during a specific period. And it gives us information that, you might not be able to see on the other two statements because those are based on accrual accounting.
Right. Right. And the authors tell us that this statement is divided into three main sections.
Yeah. First, you've got cash flows from operating activities.
Okay.
And these are the cash flows that come from the company's core business operations. So that's the day-to-day stuff that creates revenue and expenses.
Yeah.
Second, there's cash flows from investing activities, and that has to do with buying and selling long-term assets. So things like property and equipment.
Okay.
And then third, you've got cash flows from financing activities, and that's all about how the company raises money through debt and equity. So borrowing money, repaying loans, issuing stock, all of that falls under financing.
Okay. Now, the operating activities section, I gotta say, that's the one that always seems a little confusing to me.
Yeah.
Why is it that the net income that we see on the income statement, why doesn't that just directly translate into the cash generated from operations?
It goes back to that accrual basis of accounting that we talked about earlier, right?
Sure.
So remember, revenues and expenses are recorded when the economic event actually happens,
Okay.
not necessarily when the cash changes hands. So if a company sells a bunch of stuff on credit, they're going to recognize the revenue immediately,
Okay.
but the cash won't come in until the customer pays. And that could be at a different period.
Yeah.
And, depreciation expense, that's a non-cash expense. It just reflects the fact that an asset's getting used up over time,
Right.
but there's no actual cash outflow when that expense is recorded.
Okay.
So what the operating activity section does is it takes the net income and adjusts it for all those non-cash items and the timing differences to give you the actual cash flow.
Okay, so it's reconciling that difference between when something is recorded and when the cash actually moves.
Exactly. It's showing us the real impact of those operations on the cash.
Okay, so as the authors point out, managers have these three big financial responsibilities.
Right.
They have to generate profit, they have to manage assets and liabilities effectively, and they have to make sure there's a healthy cash flow.
Yeah.
And the statement of cash flows is what gives us insights into that third area.
Absolutely.
So we've got these three statements. They're all presented separately in the report,
Yeah.
but they're not really independent of each other, are they?
No, definitely not. They might be on different pages of the report, but they are absolutely interconnected.
Yeah.
What happens in one has a direct impact on the others. And the authors, they call these dual effects.
Okay. And they point to exhibits 4.1 and 4.2 in the book, which, our listeners can't see. But what's the main idea behind those exhibits?
They basically visually map out how all the line items on the income statement and the changes in those accounts on the balance sheet,
Yeah.
they all feed into the statement of cash flows. It's like a flow chart.
Yeah.
So, for example, the profit-making activities that are on the income statement, those directly affect things like accounts receivable and accounts payable on the balance sheet. And then changes in those accounts from the beginning of the year to the end of the year, they're super important when it comes to reconciling net income to cash flow from operations.
So it's kind of like this financial ecosystem
It really is, yeah.
where everything is connected.
Yeah, absolutely.
The author, John Tracy, he had this realization about all of this, didn't he?
Yeah, it's a great story.
Yeah.
Even after he'd earned his doctorate, he didn't fully get it until he saw the idea that financial statements are articulated,
Yeah.
almost like an articulated bus. You know,
Yeah.
it really emphasized that these statements, even though they look separate, they're all just parts of a whole.
Okay, so let's make this even more concrete by looking at some examples
Okay.
of how these statements are linked. Let's start with sales revenue, which is on the income statement,
Okay.
and accounts receivable, which is on the balance sheet. What's the connection there?
Well, at the end of, the accounting period, some of the sales revenue that's been recorded might not have been collected in cash yet.
Right.
Right. And that outstanding amount, that money that the customers still owe,
Right.
that's what we call accounts receivable on the balance sheet.
I see. Okay. So it's not just about the sales that have been made. It's about the money that's actually been collected.
Right.
Now, the authors talk about something called the accounts receivable turnover ratio.
Yes.
What does that tell us?
It basically tells you how efficiently the company is collecting that money that people owe it.
Okay.
So it basically tells you how many times a company collects its average accounts receivable balance over a period of time.
Okay.
And then you can convert that into, how many days it takes them to collect on average.
Okay.
So if it's a higher turnover,
Yeah.
it generally means that the company is pretty efficient at collecting its cash.
Okay.
While a lower turnover might mean that there's a problem with their credit policies or their collection efforts.
Why is that important for managers and investors to keep track of?
Well, because money that's tied up in accounts receivable, it's not available to be used for anything else.
Right.
Right? You can't use it. So if a company can actually shorten that average collection period, they're freeing up cash that can be used for all sorts of things.
Yeah.
They can invest it, they can pay down debt, they can even return it to shareholders. So it's all about optimizing that working capital. And both managers and investors, they should be looking at this ratio and thinking about, is this in line with what the company is saying about its credit terms?
Okay.
Is it in line with industry norms?
Yeah.
If there's a big difference, that could be a red flag.
Right. Okay. Now, let's talk about cost of goods sold, which is on the income statement,
Okay.
and the inventory asset, which is on the balance sheet. How are those related?
So the inventory that you see on the balance sheet, that represents the cost of the products that the company still has on hand.
Okay.
They're available to be sold in the future.
Yeah.
But the cost of goods sold, that's the cost of the inventory that they actually sold during that period.
Okay.
So those are gone. They're no longer in the inventory. So as inventory is sold, it moves from the balance sheet to the income statement
Okay.
as cost of goods sold.
Okay. So there's that direct link.
Yeah. It's
And they also talk about the average inventory holding period.
right.
How does that help us understand this?
So that basically tells you how long the company is holding on to their inventory before they sell it.
Okay.
And obviously this depends on the size of their inventory compared to the amount of goods they're selling.
Okay.
A longer holding period, that generally means they've got a bigger inventory balance compared to how much stuff they're actually selling.
Okay. So what's the ideal situation for a business when it comes to managing inventory?
Well, they want to hit that sweet spot.
Yeah.
The authors call it the Goldilocks test.
Okay.
You don't want too much and you don't want too little. If you're holding too much inventory, what's tying up your money?
Yeah.
It's costing you money to store it. And then there's the risk that the stuff becomes obsolete, especially if it's a fast-moving industry.
Right. Right.
But if you have too little, then you run the risk of running out of stock,
Yeah.
and then you lose sales. So you really have to find that balance. And the best thing to do is to compare a company's inventory turnover and that holding period to its competitors and also to its own historical trends.
Okay.
That can really tell you how efficient they are at managing inventory.
All right. That makes sense. Now let's shift to operating expenses on the income statement
Okay?
and accounts payable on the balance sheet. How are those connected?
So accounts payable, those are those short-term liabilities. It's the money that a company owes to its suppliers
Okay.
for goods and services they've already received,
Yeah.
but they haven't paid for yet.
Okay.
A lot of operating expenses like rent, utilities, admin costs,
Yeah.
those are incurred and recorded as expenses on the income statement.
Okay.
And if they haven't been paid yet by the end of the accounting period, then you'll see that in the accounts payable on the balance sheet.
Okay, so if a company has these selling, general, and administrative expenses, and maybe they haven't paid all of those bills at the end of the year,
Right.
that unpaid portion is going to be on the accounts payable.
Exactly. Exactly. So the total operating expenses on the income statement, that's all the resources they used up to generate revenue.
Okay.
And if any of those expenses haven't been paid by the time they prepare the balance sheet, well, that's going to be sitting there as a liability in accounts payable.
Okay.
And the key here is that an expense is recognized when it's incurred.
Okay.
So that's when the company has an obligation.
Right.
It doesn't necessarily mean the cash has gone out the door yet.
Okay, that makes sense.
It's about when the obligation arose.
Now, there's also this thing about operating expenses and prepaid expenses.
Right.
How do those two connect the statements?
So some operating costs, you pay for them in advance,
Okay.
like your insurance premiums,
Yeah.
or if you have an annual software subscription.
Right.
When you make those payments, they're recorded as prepaid expenses,
Okay.
which is an asset on the balance sheet because it represents a future benefit to the company. But then, as you use up that benefit over time, like let's say month by month, as you're covered by the insurance, a portion of that prepaid expense is then recognized as an actual operating expense on the income statement.
Okay. Okay. Now, let's talk about this idea of massaging the numbers,
Uh-oh.
which maybe isn't the most, ethical thing in the
Yeah.
world. So what does that even mean, and how does it relate to these connections we've been discussing?
So massaging the numbers, the authors describe it as, this subtle manipulation of the accounting figures.
Okay.
It's basically trying to make the company's performance look a little better than it actually is.
Right.
It's not quite fraud, which is like intentional misstatements.
Yeah.
But both of those things, they could distort the true picture.
Yeah.
They make it harder to understand the company's financial health.
And they mentioned that sometimes, accountants, they might feel pressured by management to do this kind of stuff.
Yeah, and that puts them in a really tough position. They're responsible for making sure the records are accurate.
Right.
But sometimes the higher-ups want them to bend the rules.
Yeah.
And make things look better.
Yeah.
So that can be a big ethical dilemma.
Okay. Well, let's move on then to depreciation expense on the income statement
Okay.
and property, plant, and equipment on the balance sheet.
Yeah.
How are those two related?
So property, plant, and equipment, those are the long-term assets
Okay.
that a company uses in its operations.
Right.
But they have a limited useful life, right?
Yeah.
So depreciation expense, it's basically spreading out the cost of those assets over their estimated useful life.
Okay.
So as the assets are used up, they wear down, their value on the balance sheet gradually gets reduced.
Okay.
And that's reflected in the depreciation expense that's recorded on the income statement.
Hmm.
It's just a way of recognizing that you're using up these assets to generate revenue,
I see.
and you're spreading that cost out.
And the authors mention that the tax code can actually play a big role in how companies decide how long that useful life is, right?
Yeah, that's a real-world consideration.
Yeah.
In theory, a company should try to estimate the actual economic useful life of its assets,
Yeah.
but in reality, they often just align it with what the IRS says they can do for tax purposes.
Okay.
And that can sometimes create differences between the depreciation that's reported for financial recording
Yeah.
and what's claimed on their taxes.
Interesting. Okay. And so depreciation is also a non-cash expense, right?
Exactly. So the cash outflow actually happens way back when you first buy the asset.
Right.
Depreciation is just an accounting thing. Host.